In January of 1980, a single dollar in old dimes and quarters, the ordinary pre-1965 kind that had been sitting forgotten in millions of coffee cans and junk drawers, was worth about $35. Not to a collector, in the metal itself. The same 4 quarters that made $1 of change in 1964 could be sold that month for the price of a week's groceries. Nobody who dropped those coins in the jar had planned it, and nobody had called it investing. This is how that jar filled. And what happened on the winter morning, the whole country tried to cash it in at once. That number is where the story ends. Here is where it begins. Millions of American families had noticed something small in their pocket change. The old dimes and quarters were silver, and the new ones were not. And they did one ordinary thing about it. They started pulling the old silver coins aside into a coffee can, a dresser drawer, a cigar box. It was not clever, and it was not investing. It was, entirely by accident, the best inflation hedge most of those households would ever hold. Start with why the coins were silver in the first place, because for most of American history, nobody thought about it at all. From 1792 onward, the dime, the quarter, and the half dollar were 90% silver, and that was simply what money was. The reason it stopped is not a conspiracy, it is arithmetic. Through the early 1960s, the industrial and photographic demand for silver climbed, and the world was using up far more of it than it was mining. President Lyndon Johnson said so plainly. Silver consumption, he noted, was running at more than double new silver production each year. And the price of silver began to rise toward a very specific, very dangerous number. The point at which the metal in a coin would be worth more than the coin. The Treasury held that line for a while by selling silver out of its own vaults at about $1.29 an ounce, the price at which a silver dollar's metal exactly equals its face. But the vault was not bottomless, and the shortage showed up first as a plain nuisance, a coin shortage. Registers ran short of change. In 1964, the Federal Reserve banks took in far less small change than the year before, because Americans had already begun holding coins back. So, Congress acted. On July 23, 1965, in the Rose Garden, Lyndon Johnson signed the Coinage Act of 1965, the first fundamental change to American coinage in 173 years, as he put it, superseding the original Act of 1792. The Act did something surgical. It took the silver entirely out of the dime and the quarter, replacing it with a sandwich of copper and nickel wrapped around a pure copper core, the coins we still carry. It did not, and this is the part almost everyone gets wrong, strip the half-dollar bare. It only cut the half from 90% silver down to 40%, a form it kept through 1970. The half-dollar lost its silver completely only later, under a separate law at the very end of 1970, with the clad halves that began in 1971. And at that signing, Johnson made a prediction. He looked directly at the fear that people would hoard the old silver coins, and he waved it away. The Treasury's silver, he said, would keep the price in line, and in his words, there will be no profit in holding them out of circulation for the value of their silver content. The old coins and the new, he promised, would circulate side by side. He was wrong? Not a little wrong. Completely wrong. And at least one congressman knew it in the room. Representative Silvio Conte of Massachusetts had conceded on the floor that an older law would override the president's optimism. A law named for a 16th century English financier. That law is Gresham's law, and it is one of the oldest observations in economics. Bad money drives out good. When 2 coins must be accepted at the same value, but one is worth more as metal, people spend the cheap one and keep the dear one. Nobody has to organize it. It needs no belief in silver, no distrust of the government, no forecast about inflation. People simply, quietly keep the better coin. And that is exactly what a nation of households did. when the Treasury finally stopped propping up the price in the middle of 1967, silver broke past that dangerous number, and by the end of that year, it was over $2 an ounce. Now the silver in a dime was worth more than a dime. The silver in a quarter was worth more than a quarter. So the silver coins simply left. The last of the 90% coins were struck in early 1966, and within a few years, the roughly 12 billion silver coins in American pockets had drained out of circulation into jars and drawers, as if the country had exhaled. By the early 1970s, finding a real silver quarter in your change was already a small event. Now set that against a household budget, because this is a channel about ledgers, and this line is a strange one. Picture the family we keep coming back to on this channel, an illustrative composite, a single paycheck household a little above the middle, everything about them drawn from the real prices of the day. Somewhere in the late 60s, one of them, the one who sorted the coins out of the change on a Friday, started noticing the dates and set the pre-1965 dimes and quarters into a jar on the shelf. It was not a line with a dollar amount next to it. Not really. It was a weight. Every dollar of face value in 90% coins holds about 7/10 of a troy ounce of silver, a figure fixed by the mint and easy to check. So the jar had a hidden second value that moved on its own, without a single new coin going in. Watch it move. In 1970, silver averaged about $1.77 an ounce, so a dollar of coins in that jar held maybe $1.25 of metal. Barely more than face, not exciting. But the same decade that was eating the family's grocery money and mortgaging their house at rates climbing toward 18% was doing the opposite to that jar. By 1974, silver was near $4.70. By 1978, past $5. A dollar of coins now held close to $4 of silver. The paycheck was losing to inflation every single year. The coins in the jar were winning, for the same reason and by the same clock, because the dollar itself was being redefined, and silver was one of the few things that showed that redefinition in real time. In 1968, the government had even stopped letting you trade paper dollars, the old silver certificates, for actual silver. The only silver left in ordinary hands was the silver already in the jar. Then came the part nobody in that kitchen could have imagined, and it did not come from a kitchen. It came from Texas. Two brothers, Nelson Bunker Hunt and William Herbert Hunt, sons of the oil billionaire H.L. Hunt, had spent years buying silver, distrustful of paper money, and convinced the metal was the only honest asset left. Through the 1970s, they gathered tens of millions of ounces, and in 1979, they went further than anyone ever had, setting out to buy very nearly as much of it as physically existed. By the first day of 1980, the Hunts and their circle controlled something like 195 million ounces of silver, on the order of a third of all the silver in private hands on Earth. A price that had started 1979 near $6 an ounce ended at near $34. The exchanges panicked. In January of 1980, the New York Commodity Exchange, the COMEX, changed its own rules, limiting who could buy, forcing the market toward selling only. And on the 18th of January 1980, silver hit its record, about $49.45 an ounce on the London fixing, and just over $50 in the frenzy of the New York trading floor. Do the arithmetic on the jar. At nearly $50 an ounce, that dollar of old dimes and quarters, the ones that had been sitting on the shelf gathering dust for a decade, was worth about $35 in pure metal. 35 times face. $1,000 in coins, the kind of bag a coin dealer traded, held around $35,000 of silver. And ordinary people knew it. In its issue that January, Time magazine ran a piece called The Great Sell-Off and described the scene. 250 people standing in line outside a single coin shop in Los Angeles. A buying office on the 66th floor of the Empire State Building. Packed with, in the magazine's words, students, housewives, executives, and pensioners, carrying their silver in pockets, in shoeboxes, in shopping bags, and even in pillowcases. They were selling the tea service, the flatware, the jewelry, and the coffee cans of coins. The accidental hedge was being cashed in by the millions near the very top. That is worth sitting with, because it is the honest center of this story, and it cuts against the tidy version. The families who sold in January of 1980 did not sell at the top because they were shrewd. They sold because everyone was selling, because the number in the newspaper was finally big enough to walk downtown for. It was luck of timing dressed up later as foresight. And the coins that were sold mostly did not survive. Dealers shipped bag after bag to the refiners. One Indiana dealer alone sent thousands of bags to the melting pots, and a large share of every silver coin America had ever struck went into the furnace in those months. It is the reason the coins are called junk silver today, and the reason they are scarcer than they should be. And then the top gave way. The Hunts had bought much of their silver with borrowed money, and when the price stopped rising, the loans came due. On the 27th of March, 1980, a day the markets remember as Silver Thursday, silver collapsed from around $21 to about $10.80 an ounce in a single session. The Hunts could not meet their margin call. Their brokerage was left holding an unsecured debt of roughly $122 million, and for a few hours, it looked as though the fall of two Texas oilmen might take a piece of Wall Street with it. It took $1 billion bank rescue to contain it. The day before the crash, the jeweler Tiffany & Company had taken out a full-page ad in the New York Times, calling it unconscionable for anyone to hoard billions of dollars of silver. Years later, a jury would find the Hunt brothers had illegally conspired to corner the market. It was a civil finding, not a crime on the books at the time. And in 1988, the men who had tried to buy all the silver in the world filed for bankruptcy. The family that had held its jar past January, waiting for more, watched the metal give back 3/4 of its value in 2 months. So what was the jar really? Not a strategy. Nobody drew up a plan to beat inflation with pocket change, and this is not a suggestion that anyone do so now. The jar was something quieter and, I think, more interesting than a strategy. It was a thermometer. The metal value of a coin is one of the few readings a household can hold in its hand of what is happening to the money itself. And when that reading climbs, it is not the silver getting precious so much as the dollar getting thin. The government read that same thermometer in 1965 and pulled the silver out of the coins, precisely because the metal had become worth more than the money. The families who kept the old coins were reading the identical signal from the other end, without a single economics book, just by noticing the date on a dime. They did not outsmart the decade. They held, by accident, a small piece of one of the few things that decade could not inflate away. And in doing so, they kept, in a jar on a shelf, an honest record of exactly how much the dollar in the bank was quietly losing. That record is still legible. You can still find the 1964 dime and the 1965 one, and read the whole story in the year stamped on the face.